podcast where we put you on the map. This is Ron Costa broadcasting live in the Mappable USA studios in Las Vegas. And boy, folks, we got another great show coming at you. The last one we went into all this kind of crowdfunding and tokenization and blockchain, and I think we just kind of blew everyone away on that one. But now we get back into opportunity zones and go into a couple of interesting points and trends on that. So let's bring in Vicki Hutchmala from the QOZ Marketplace. Vicki, are you out there?
I'm here, Ron, in beautiful Las Vegas, having a wonderful day, and very excited today to talk with Blake Christain, a CPA who's going to help us understand opportunity zones from a money perspective.
Absolutely. So let's introduce Blake Christain again from HCVT Accountants. And Blake, how are you doing today out there?
Doing great. Glad to be on the phone with you today.
This is a repeat performance for you. Thanks for coming on again. It's nice to have repeat guests.
Well, it's an honor. Thank you.
So listen, there's so much going on with this opportunity zone. It's about 2 years old right now, and there's so many trends and issues going on. I thought maybe we'd start the show off. Well, first of all, let's remind everybody what you do. Can you tell us a little about what HCVT is?
Sure. So HCVT is a full-service CPA firm, and we have 13 offices, predominantly in Southern California, but also offices in Northern California. I work out of the Park City office predominantly. We have Phoenix, Arizona, and we also have an office in Fort Worth, Texas.
Wow.
Okay, good. And I know you go to a lot of the industry conferences. I believe you just attended one in New York City. Is that right?
Right. I ran a panel that we covered operating businesses using the Opportunity Zone program, and that's about 50% of my practice is active businesses, and then the other half is real estate development. So it's a lot of fun to do both of those.
It keeps you on your toes for sure. So now, what do you think is going out there right now? Again, we talked about it, the Opportunity Zones program being about 2 years old now, more or less. You said something interesting the other day about this, where the conferences that you're going to now, they're getting a little bit more in detail, they're a little bit more substance than they were originally. Is that because the program is evolving and people are starting to get a general direction of what it can do and how powerful it could be?
Absolutely. So, what we saw the first round of conferences, and I've attended and spoken at a lot of these, but it was kind of like pretty high level, and here's all the benefits and things. But now we're getting into the practical aspects. How do you structure these? What's the pitfalls? What's the workarounds? And Treasury's done a fantastic job in the two proposed regs that have been issued, and they've also given some other guidance. There's a handful of open issues that are not insignificant, but again, for a fairly complex program, I think Treasury's done a great job in a relatively short time giving us guidance. So they're definitely up and running. We've formed probably a dozen of these within our firm. There's multiple hundreds that have been formed across the U.S.
So when you say that you've formed these out of your CPA firm, what exactly does that involve?
Well, of course, we do work with our clients' attorneys, but a big part of my practice is what I would kind of refer to as family office situations, where somebody has sold a significant real estate project, or they've sold a chunk of publicly traded stock, or had some other gain flowing out of an entity, and so we will set up a kind of a captive Opportunity Zone fund for them to roll that gain in. And again, as I said, half of my projects are operating businesses, so they're serial entrepreneurs, and they just roll that the large gain into another business or multiple businesses. And the rest of them are real estate projects. And I do work. I have two clients that are what I would refer to as public opportunity zone funds, which will raise money from outside parties, but most of it's just kind of in-house money, and those are, less cost than you have in some of these public, what I'd call, the public Oz funds that have some hefty fees in them.
Well, there'd be a lot more marketing and legwork actually to find the investors to go into a fund like that.
That's correct.
So when people are creating these funds, and of course, we know that opportunity zones funds are using capital gain assets. Is it possible, or are you doing, or is it recommended that you can use other assets in addition to the capital gain assets in a single fund? Or do you have to have two structures?
If somebody brings in non-capital gain.
Exactly.
Yeah.
If they have assets they want to invest, and they have capital gains assets, but then they also have just investment money, can you commingle them together in one fund?
Absolutely. The regulations, foresaw that, and you can absolutely have what I call after-tax money, as well as your deferred gain going into an opportunity zone fund. And, and people scratch their head and say, why would somebody do that? But, we do have, we run into those situations where some other family member may not have the gain, but they are convinced that this, real estate project or operating business is going to do better than, they can find somewhere else, and so they'll throw their money into the fund also. What that does is it creates what's called a mixed fund,
right?
And so you basically just end up within that opportunity zone fund. You'd have one bucket that's qualified money, and the other is non-qualified money. The non-qualified money won't get the step-ups at years 5, 7, and 10, but the other bucket will.
Well, that just creates more accounting, and that's a good thing for you.
Well, although I don't encourage the mixed funds because of what you just said. I don't. I'm busy enough without adding
for mentioning that.
adding complexities to it. But we're just because of every project's unique, we're absolutely going to have some mixed fund situations, and
that helps the public funds. It gives them a little bit more marketability to say, but even if you don't have capital gains, you still can invest in this project that we're doing in an opportunity zone.
Right. I do want to interject that because I hear people talk about this, and it would be the biggest mistake I think anybody could do is don't invest in one of these through a qualified plan, an IRA, a pension plan, anything like that. It would be that would be pretty insane because you're going to get no, that's going.
You're going to lose the amount of potential income.
Right.
Yeah, on these mixed funds, though, you still get the benefit of the fund gaining value. You're not paying taxes on that appreciation still. Is that right?
Well,
on a mix,
again,
if you bring in,
So if somebody, go ahead. I'm sorry, Ron.
No, that's okay. If you bring in money into a fund that's not capital gains taxes, like we just talked about, and we call it a mixed fund. Let's say, for example, I do that at the end when the fund, let's say, doubles in value, I still don't have to pay taxes on that double in value, though. That's the attractive part of that, right?
I'm glad you bring that issue up because that I have to burst your bubble there that you're not going to get that person that put in the after-tax money, they didn't roll a deferred gain into it, they are going to get absolutely no tax break. They're going to just pay tax. Yeah. But again,
wow.
people will do that to piggyback on, a friend of a friend's real estate project or something, because they go, oh man, they had an insider deal. They had bought, that land, a couple of years ago. They're going to sell it to the QOF. Everything works out. I think that's going to be a great successful, hotel project or, multifamily project. It should appreciate better than most, just because it's in a, rebounding area.
But
I bet you we just did somebody a big favor on that right now, listening to this podcast. So,
yeah, well, I get that. Yeah, you're about the 20th person that's asked me that, and it, there is a misconception
that invested their capital gains income, they still get the tax benefit, though, right?
Absolutely, on that bucket within the
they still are eligible for the tax deferment. It's just the folks that don't put the capital gains in that just treat it as a regular investment.
Right. And one technique, if you wanted to bring another family member in, you could gift some stock to that person or gift some of the land to them, and then have them sell it, and they would have the capital gain. So there's definitely ways to to shift capital gain to somebody else that wants to get involved in the QOF and have the better holding, the better qualified deal. Investment. Yeah.
So tell us what you're finding in the last 2 years that is more challenging now that more people know about it compared to in the beginning when everybody was just looking at the tax incentive. Now what's happening now that people are actually involved in it?
Yeah, so there's a few things. One is a lot of our work on the front end is making sure somebody has an eligible gain. And as you pointed out, it's capital gain income. It can be short-term. It can be long-term. And a lot of people don't realize that short-term gains can go in here. It can't be ordinary income. So if somebody had stock options that created ordinary income, that couldn't be rolled into a QOF, Qualified Opportunity Fund. So we spend time educating people and evaluating whether they have an eligible gain. Part two of that is when does the 180-day rule start tolling? And that gets very complicated. I was talking to one of my partners last night, and it was an installment sale that started in 2017. Obviously, that gain is too old and cold, but then they collected additional gain in 2019. But she had the misperception that everything that happened in 2019, the tolling of the 180 days doesn't start till December 31st. Well, that particular gain was not going to be on a K-1, so the tolling happened on the date they collected that additional installment sale. Luckily, we're still within the 180 days, but she had the potential of telling a client that they had an eligible, that they had until June of 2020 to invest, and they really didn't.
Right.
So, and there's going to be some additional clarification in the final regs, because if there's 1231 gain, which is an asset held in a trade or business, that'd be like a piece of land or a rental property that's in a partnership or an S corp, or if an S corp sold a piece of machinery at a gain, which would be unusual, but those are 1231. Those don't get recognized until December 31st of this year, and you have 180 days. But you really need to know those rules, and anybody practicing in this area really has to be careful about how they're advising clients. I'll tell you, the IRS is going to have a field day, because there are going to be a lot, when they start peeling back the onions, there's going to be a whole lot of, qualified opportunity funds that people thought were eligible but may have, not had a proper gain or missed the 180-day rule. But at the same time, I think the IRS will probably be somewhat lenient on that, but we can't be sure how they're going to audit these down the road.
Well, and confusion, because it's a brand new program, there's got to be a lot of that where you've got to just recognize that you didn't make it clear enough in the beginning for people to quite understand what they were doing.
Right.
So explain to us the relationship between owning a building, owning the land, and creating an opportunity zone fund.
Yeah, that's probably the single, biggest issue that we deal with on the real estate development side. So just to kind of go over the rules, and again, they get fairly tricky. But so let's say that I own a piece of land that I bought in 2010. So the fact that I bought it before 2018, but it's in an opportunity zone, that doesn't mean that I get any benefit out of it because I owned it too early. And so, but there are ways that you can kind of refresh that and make it opportunity zone eligible. And the one way would be to sell it to a fund or some other party that you'll co-develop it with. But then in the code of the regulations, there's a related party rule. And throughout the code, usually related party is 50% or more common ownership. In this, they moved the threshold way down to 20%. So if I own a piece of land and then I sell it to a QOF and I retain more than 20% ownership interest in that, then that asset is not a good asset in that opportunity zone fund. Now, that may not be the end of the world, because if you're going to build let's say it's a $3 million piece of land, but I'm going to build a building on it that's going to be $10 million, that since the land is less than 30% of the total project, the fact that it's not a qualified asset doesn't blow your whole qualified opportunity fund, and that would have to be pushed down to a qualified opportunity zone business to meet the 30% test. So there's a whole lot of landmines out there on how you structure these. And so really I've just gone over one of three ways you can get that asset in. So that would be one way. That's one workaround, where as long as the land is going to be less than 30% of the total ending value of the project, you'd still be okay. But you still wouldn't want the owner or owners of that land to be more than 20% owners of the QOF. The second way is that you could contribute that land to a QOF, and by doing that, the second set of regulations allow you to use that asset. It doesn't have to be land; it could be some other asset. You can contribute that to the QOF, and that is viewed as similar to putting cash into it, and they allow you to the whole deferral under the Oz provisions. But again, very tricky. The only thing you get credit for is the qualified investment is limited to your tax basis in that land. So if you're sitting on highly appreciated land, that strategy is not going to work very well. If you end up contributing a piece of land that the fair market value and the tax basis is pretty close, then you're going to get closer to 100% of that value being eligible to defer your gain. And so a piece of land that you bought in the last 2 or 3 years probably has a better chance of being a good asset to contribute versus something you've owned for 10 or 15 years.
Okay. That I get it.
Yeah, but there's a big elephant in the room here with this, I think, because when you create this fund, and let's say this fund isn't created correctly from the qualifying aspects that you just talked about, Blake, right? And if I'm an investor and I want to invest my capital gains taxes in this fund that is not created properly, let's say, then even though I may be an investor into this thing thinking that I'm investing in an opportunity zone that could take the tax benefits, you won't get them, right?
Right. And that's
where
your potential service of certifying funds comes into play because this is not not an area of investing that you want to go into without being assured that the parties involved in formation and running the opportunity funds, you need to make sure that they know what they're doing.
Yeah, and if you're thinking of deferring all those taxes over all these years, and all of a sudden the IRS comes and audits you, they're not going to take kindly to, hey, I didn't know, right? They don't like ignorance.
Right.
Nobody likes it.
Yeah. So this is a huge issue, I think, with the funds in general. And back to your point on being very careful about how it's set up and keeping in track with all the dates and the timelines. There's all kinds of things. Another one that we talked about the other day was this requirement of substantially improving the property. You're familiar with that one too, right?
Yes.
All right. There's a time limit on that as well, I think.
Right. So if it's real estate, then the general rule is going to be you have 30 months to improve the building portion of the asset. So if you go in and you buy something with land and a building on it already, then you have 30 months. Well, first of all, you have to get a valuation and determine, what is the land value and what is the building value. Again, I'll just use $10 million, and let's say the land is worth $3 million, the building $7 million. You have 30 months to make improvements to the building to double your basis. So you have to put another $7 million into that building to refresh it, and then you are treated as the original owner, and it's a qualified asset. If you miss that, then you're holding essentially a non-qualified asset, and you've essentially have a blown quaff. Now the regulations, if it takes longer to get your building permits and things, they will not, that 30 months can flex a bit, but then there's this, if you're dealing with an operating business, and this is where we hope they'll fix it in the regulations. But right now, if I go in and buy an operating business, let's say it's a manufacturing plant in an opportunity zone, I have to go in on an asset by asset basis, and I have to make a doubling of the basis of a lathe, that planing machine, that CNC machine, and it's impractical. Nobody would ever meet that test. And so a lot of the commentators in the second round of regulations said, hey, you need to have an aggregate test rather than an asset-by-asset test. And the same would hold true if you have two buildings on a project that you bought. You have to improve both of those. You can't just let one sit dormant and put all your money in the other one. We thought before the regs came out that would be a logical. I was telling people, just build another tower and leave the other one by themselves. But they took kind of a hard, kind of an impractical line on that in the regulations, second set of regulations.
Yeah, well, and now who makes the assessment? Is this a real estate appraiser that determines, in this case, a real estate, of course? Is it a real estate appraiser? Is it a broker? Or is there anybody that specifically is required?
I mean, I get this question all the time, and people are going, "Oh, there's another piece of land down the way, and so the building, we feel like the building has zero value." Because I can buy. And it's like, come on, you work in the you work in the real estate industry. The building has more than zero value, so people are pushing the limits on this. And I advise people to get appraisal. I mean, there's millions of dollars at stake here, so spend the money, get the appraisal. You could certainly talk to the appraiser and say, let them understand how the rules work, and but you can definitely get in a lot of trouble if you're too aggressive on allocation of land.
It's like that story of the old, you go to an appraiser and how much is my building worth? And the appraiser says, well, how much do you want it to be worth? That kind of thing. You don't want to get into that situation at all. So,
right.
And plus if it says it's zero value, even if you double that, it's still zero, right? So if the zero doesn't work.
Yeah. Right, exactly.
So it's really not to anybody's advantage. Sometimes we've heard where people think, well, I've got this piece of property or I have this building, and so I'm going to put it in the opportunity zone, and I'm going to declare its value or try to sell it at more because it's in an opportunity zone, so that gives me a little better leverage. But in essence, that's really not a good thing. You don't want it to be worth more than you think it is just because it's in an opportunity zone.
Absolutely right.
Yeah, and one other point I wanted to touch on the real estate end of it is everybody talks about the 1031s and the differences between that and the qualified opportunity zones. From an accountant's perspective, if someone walks into your office and says, well, I got these capital gains on a big piece of land I sold, how do you advise them? What kind of questions do you ask them to determine whether or not they should go 1031 or a opportunity zone fund?
Great question, Ron. And because I still do a lot of work in California, and California is one of the 5 states that has yet, and they won't pretty much adopt the program. And so if I'm dealing with one of my clients in California and they are disposing of a piece of real estate at a gain, even though I promote the Oz program, it's full stop, don't do an Oz deal, do a 1031, because that way they can defer both federal and California tax. If they do an Oz investment, even if it's in California, they're going to still pay full California tax, which can be up to 13.3%, even on a capital gain. So if it's real estate, I push them to a 1031. If they're in one of the other conforming states, I'll still talk to them about 1031. Is the person, if this is a 75-year-old taxpayer that's rolling a gain, I'll tell them, do a 1031, because when that person passes away, their heirs get a full step up in fair market value of that asset, and they can sell it the next day. If they do an Oz investment, they just step into the shoes of the investor, and they'll still have to wait the full 10-year period. There's no step up on death under the Oz program, so big differences.
Yeah, they have to be understood for sure. We did a podcast a couple of weeks back on the difference between the 1031s and the QOZ funds. And we got a lot of questions after that one because, listen, real estate is a very hot topic. And another really interesting thing about that too is real estate has an option, basically, like we just talked about. If you have let's say a business, you're selling a business, then obviously a 1031 doesn't suit you at all. So really, you're going to have to really look into the opportunity zone funds almost as a default, other than paying the taxes, I guess. So
exactly.
Yeah, a lot of options out there for people out there. And I think that's one of the greatest things about this Opportunity Zone program, because it allows that extra umbrella of all types of assets. Even like you're going to sell art, or you're going to sell your car or a classic vehicle or something like that. It really covers everything, which is a really strong part. I think it's just one of the strongest parts of the whole program. Plus,
Yeah.
we talked about before the appreciation on the fund, for the right for the qualification, for the right investment, I should say. So we got that point taken care of early in the podcast, which everyone out there listening needs to listen to. Go rewind this on the archive if you haven't heard it before. But a great point by you, Blake. I really think you nailed it on that.
Well, just one other tie-in on the 1031 is I've written an article about as you're talking about, flexibility of the program, and one of the things, it's a great safety net for a blown 1031. You only have 180 days to close a 1031 transaction, and if you can't find replacement property in that period, you just roll the money into a QOF, and now you have 3 to 4 years to make. You can do a ground buildup of a new piece of property and still meet the QOF test. You could never do that. You can't build a building in 6 months under the 1031 provisions, which are very restrictive. So it's a great safety net for that.
Is that a real world example? Have you had clients that have to have done that? Or
Oh yeah, I've got well, it hasn't been blown yet, but I have a California client, $50 million commercial property, been held in the family business for 3 generations, and so they're going to replace it with 6 different properties. I can guarantee you one of those is I just know the law of large numbers. One of those properties will not close in time, and so at least we're not going to be able to save the California tax, but at least save the federal tax. So we have that at the ready if we can't close within the 180 days.
Well,
okay.
and Blake, I think that what's really important that people need to understand, especially with what you do, is everybody concentrates on the capital gains tax and the deferments from capital gains, but nobody really understands the fact that not all states have qualified opportunity zones, and also you have to know the tax consequences at a local level. What is the state doing? What are the municipalities doing in terms of taxes? And are you prepared for that aspect of having an opportunity zone fund as well?
Right. And the other thing is, it's a pretty mobile society. And so, and especially if you're dealing with somebody in their 50s or 60s, they may retire to another state.
Exactly.
And that's uncharted waters. How are states that, let's say somebody, is in Arizona, which is a conforming state, but decides to go retire in California, is California going to tax that, that QOF investment when they exit in 10 years? Probably so. So you kind of have to, think through some of those things out in the future as you're, making these types of investments and forming these.
It always comes down to the details. If you don't know the details, if you don't have all of the information before you even start, then the potential is not very good. But that leads me to ask a question. What if someone has invested and thought they were doing everything exactly correctly, and a little down the road they realize, we didn't do this, or we missed doing that, or we didn't really understand what we were doing? Can you fix an opportunity zone after the fact?
Well, again, I think because of the complexities, the fact that we're still operating under proposed regulations that are not, don't address every issue. There's the concept of substantial compliance, and it's not. That's just kind of a, you hear that in certain court cases and things. That if the party has done everything to the best of their ability, and there's, you've made one little mistake, IRS can absolutely come after you. Whether they're going I don't foresee them taking a super hard line on these for little innocent mistakes or, a little foot fault because they hadn't completed, because we didn't have regulatory guidance. I don't think they're going to blow up the QOF for one error like that. But I think because it, there's going to be multiple investors in these. But we got to try and conform as close to the rules as possible as we know them and interpret them right now.
Well, there's no history with opportunity zones either, so it's not like you can say, oh, well, this is what happened, and so therefore this is what we need to do. That's not really possible without a history of what's going on. So they're kind of just creating it as they go and hoping that everybody's doing it correctly. But even if you did forget something or you did misinterpret something, at least the effort of trying to fix it probably would go a long way with the IRS anyway, right?
Absolutely.
So,
we have to remember there's going to be tens of thousands of these, by the time 2026 rolls around, and not that you want to be cavalier with thinking that you're going to dodge an IRS audit, but the IRS isn't going to be able to audit every single one of these, so they're going to go after the larger ones or the ones that have obvious problems with them. So again, we're advising clients to be, follow the letter of the law as best we can interpret it. And I would, I just encourage everybody to get good counsel. You need a good attorney that's worked in this area before, a good CPA, and the best thing, you need somebody with a good business plan, and or a good
no question.
Plan. Yeah.
Yep, absolutely. And Blake, if somebody wants to check up on some of the things that you're doing and maybe read some of those articles that you mentioned earlier on your website or blog, how do people get a hold of you?
Right. So our website is hcvt.com, and my number is 435-200-9262. If you Google Opportunity Zones and HCVT or Opportunity Zones and Blake Christain, my articles will pop up. And we do have on our website a landing page for Opportunity Zones, and there's 20, 30 articles in there.
Yeah, excellent. No, we'll definitely link all this stuff in the show notes, so people who are listening to that, just go to the notes, and you'll see links to all of Blake's stuff and everything that we talked about today. And I got to close this out by just saying, Vicki, after this podcast, I can certainly see the need for the Opportunity Zones Authority, don't you?
Absolutely, because there's so many people out there that think, oh, I've got capital gain, so now I can do this. It's not as easy as it appears, as Blake just said. If you don't know the details and you don't have professional people helping you to create the fund and maintain the fund, and people, professionals who are going to develop the fund and have a reputation for success, then, you're just shooting yourself in the foot every time.
Right.
Yeah, no question.
I was going to say about 20% of our business also is assisting other CPA firms, and so we can just kind of be their back office support for formation and managing opportunity zones, opportunity zone funds.
Excellent. And Blake, you're everywhere on the internet. You're all over the place on these expos and traveling all around, talking opportunity zones. I know you're very busy, and I got to tell you, I really, really appreciate you taking the time out to speak to us today on this topic. It was really, really much appreciated. I think you opened up a lot of eyes today, so I thank you very much.
Again, thank you for the opportunity.
Absolutely.
Always a pleasure to talk to both of you. Thank you.
If I could ask you one last question, Blake, if someone came to you and said, I heard about this thing called Opportunity Zones, what would be your best initial advice to that person?
Well, what I try and ferret out, I ask how large their gain is, or gains down the road that they might have, and if it's $500,000 or more, then I'll direct them to setting up their own fund. If it's less than that, then I would suggest that they look at one of the public funds. But the best advice I can give them is if you're going to invest in an outside public fund, you need a professional going through and highlighting all of the fees and the carried interest and any self-dealing they've had. A lot of these investment funds, they're buying buildings that they already own at inflated prices. There's a whole lot of bad costs that are in some of these. They're not all bad, but they're the majority that I've reviewed have some very, very high fees that can wipe out a lot of the long-term benefits of the Oz program.
Sounds good.
Yeah, that's a strong way to close it out. So listen, we're running out of time here. Let me close out this podcast out there. You're listening to the Mappable USA podcast at mappableusa.com, where we put you on the map. Go to the website, scroll down on that homepage. You'll see all our syndication sources. We're pretty much everywhere, just like Blake is these days. So check us out, subscribe so you don't miss another episode. And another thing, if you want to be a guest on the show, like Blake was today, there's a guest tab. You can fill that out, and we get that message. We'll see about getting you on the show as well. So once again, thank you everyone for subscribing. Thank you all for your support, and we'll see you next week on another Mappable USA podcast. Have a great week, everyone.